U.S. weekly jobless claims dropped sharply. Second quarter GDP growth unrevised at 6.4%. The number of Americans filing new claims for unemployment benefits dropped more than expected last week as layoffs subsided, with companies desperate for workers to meet surging demand unleashed by a rapidly reopening economy. Initial claims for state unemployment benefits total a seasonally adjusted 406,000 for the week ended May 22nd compared to 444,000 in the prior week. They are attributing some of this decline that we saw last week basically due to the pandemic relief packages. Basically, the pandemic-related restrictions on businesses have been rolled back, with more than half of adults in the United States fully vaccinated against COVID-19, leaving factories, construction sites, restaurants, and bars among many clamoring for workers. The labor shortage, despite nearly 10 million Americans being officially unemployed, has been blamed on the safety net strengthening during the pandemic. People are getting more money by staying home than going to work, and this is the reason why we had a sluggish pretty much numbers the last month. Republican governors in at least 23 states, including Florida and Texas, have announced that they are ending unemployment programs funded by the federal government next month, including a weekly $300 subsidy, which businesses say are discouraging the jobless from seeking work. The 10-year note is slightly higher this morning at 161, up about 2.37%. So we're getting a little bit of an effect on the interest rate markets. And we want to make sure that the rates on the 10-year do not exceed the prior high that we saw, 177. And so we may be establishing a trading range on interest rates on the 10-year note between 155, or the low that we saw here was 146 on the spike down. 146, more likely the average is about 152 to about 177. And I think interest rates are going to play an important part in the next few months here as we accelerate into the third and the fourth quarter of this year. We're going to begin to see, I believe, a lot more volatility. Now, the effect that most people interpret interest rates to have with gold basically is that higher interest rates is bearish for gold. I think in this case, with interest rates being where they are, in nominal terms, they're in negative territory. Particularly when you begin to factor in inflation at about 4.2%, which is according to the formula that the Feds calculate inflation. If you take a look at the real inflation rate by incorporating basically the food and energy sector, we get inflation a lot higher than that, and I think. ShadowStats.com shows you clearly what the inflation level looks like when you factor in the food and the energy prices. So, we're beginning to feel the pressure of inflation, not only in price inflation as a consequence of what's happening now. This velocity of money is coming into the economy. Everybody's running, chasing goods that we seem to be short of supply, from plastics to computer chips to, just about everything across the board. So I think we're going to see a bit of a squeeze into the summertime, a spike move in prices. I mean, when you even take a look at real estate prices, they've been just exploded. And that's not deflationary by any means. The stock market making new highs. Everything is making new highs except gold and silver. And this is the frustrating part of trading in these metals, that you would think that, with everything else going the way it is, that we would see some kind of a reaction in the metals to adjust to that. And I think we will. I think we will. I think part of the problem that we have right now is that there are too many bulls out there. The sentiment is extremely bullish. We do have the fundamentals obviously painting an extremely bullish picture with regards to the dollar position as the world's U.S. reserve currency, and what this creation of money is doing to its purchasing power. But it's not just the U.S. dollar. We're looking at the global currencies in a state of an inflationary environment, or a depreciating or devaluating levels with regards to its currency value and purchasing power. So the debt just continues to mount. And I think just in the Biden administration alone, we've seen about $6 trillion approximately, and there's no end in sight. So we're at another change in paradigm in terms of the velocity of money, or people coming back into the economy, people coming back into work, normalizing their lives again, socially, business-wise, and personally, is a major challenge, because there is still that uncertainty in terms of what we should do. Should we wear a mask? Not wear a mask now. If you're vaccinated, there's just a lot of still uncertainty in the market, and that's going to cause a lot of volatility. I think if you want to take a look at volatility, the leader in volatility that is setting up a benchmark is Coinbase. If you're looking at the asset that we've been suggesting and trading here, it's incredibly volatile, and with the kind of just rhetoric that we are seeing out there from Elon Musk to all these other gurus, it's just an amazing level of volatility that we're seeing, and that is just, I believe, setting up the standards for the markets, for the rest of the markets, for the equity markets, for the metal markets, for most of the markets, with regards to what volatility can do. In the fact that we're getting this kind of volatility in the virtual currency markets is an indication, basically, of what the markets need, what they want, and it's pulling in pretty much the rest of the markets to experience that kind of volatility. So it is breaking the benchmark of volatility. It is not a currency, it's a digital asset, but it is the most volatile asset that I have seen, obviously, in all my years of being in this business. And it's setting up a whole new paradigm, a whole new dimension, a whole new economy, which is a virtual economy. And pretty much it's moving us, the physical economy, into the direction that we transformed basically as of last year, when we saw the collapse in March of 2020. And what we have seen here since then is you know, particularly when you take a look at the at the equity markets here, they've been just continuing to explode. 4201 trading last. It doubled pretty much almost since last year. This is basically the markets dictating, anticipating what this pandemic did. And certainly, when you take a look at the at the equity markets, you can clearly see the separation, you might say, of the old economy and how it moved into this this new economy, you might say, that we're looking at right now. 29.23 was the low in August, and prior to that, lower in March. But we're taking a look at the daily. Let me take a look at the weekly here. 21.74 was the low made on March 23rd. It's just amazing, an amazing run that shifted basically the physical economy into a virtual economy, and it anticipated this explosive growth that we have on the virtual markets, the virtual economy. Bitcoin, Coinbase was created, and even though we've seen this tremendous decline on Coinbase since the high was made when the IPO first was initiated at 429.54 back in April, we've come down again almost 50% to 208 in just since April. And I believe that this is as you can see in the green bar, a perfect confirmation on a weekly basis. A key, weekly reversal is taking place. And I want to focus on this because the demand in virtual currencies is not going away. It's become a market that you have to reckon with, not only financially but politically. And what basically is dictating is that what the people want. They don't want to hold dollars. They rather hold coin, or they rather hold Bitcoin. And so for our trading in terms of the virtual currencies, just to facilitate and simplify the process, we trade GBTC, which is the grayscale Bitcoin investment trust that we've been trading aggressively, and we've done quite well. But you have to trade it. It's if you want to hold it, like some of these gurus are saying, and you are willing to to take a 50% correction, that's fine. But that's not the way to build wealth. What you hear recently, particularly in the digital currency markets, is the amount of wealth that has been lost. People have lost their fortunes, savings, for going into this. Just on this correction that we have seen. Obviously, people have made fortunes as well, if they held on to it, going back to the beginning, obviously. But it's become a more tradable market. It's become, obviously, a very, very, you might say, active market in the media. And the volume has increased. pretty much value, of the whole market has increased tremendously, but it's still very small relative to the gold market. Nevertheless, it is a great tradable instrument, and we do use the VCPMI to identify trading opportunities here. So it's great that we have these instruments that we can trade. And that's pretty much what it's what this is about here, is how do we use the VCPMI, which is the variable change in price momentum indicator, to trade this aggressive markets. We've seen a turnaround on palladium this morning, sharply higher, and it held this tremendous trend line here. So I think after this correction that we saw in early May, we are coming down to the completion of this correction and resuming the uptrends in the metals. Here in palladium, let's take a look at platinum here as well. These are markets that are not being discussed openly, but they are offering just an amazing potential, but they're not that liquid, so you want to be careful in terms of what instruments that you use. But we are beginning to see, like you see here in platinum, consolidation taking place, and so it's offering a tremendous potential once we complete this slight correction that seems to be unfolding here, and particularly as we come in and activate into the levels here of by 1 or by 2. You want to maintain a long-term bias, as I keep saying here, and use these levels to trade the market short term. Where we are right now with silver, we're trading below the average price weekly of 27.94 and the daily average of 27.93. And as I mentioned to you, traders in my private trading room here in Discord, this is the harmonic relationship that is very important to identify the direction of the momentum. It identifies the price momentum, the resolution of the momentum. And the idea of what we do here is called mean reversion trading, that particularly when the market is at its mean or its 50-50 standard deviation, we don't really trade it actively, as it can be choppy either way, but we wait for the highest probability. And this is what I say to you guys: wait till the highest probability. When you get that, regardless of what brought the market down here, as it did on the 21st of May, it came down into this blue level that the AI pretty much suggests that for you to accumulate, that it's an area of accumulation. And here's where you look for the signals, look for the market reaction, and here entered a buy trigger, and automatically it activates the targets above that you can use if you're using multiple positions. If you get out and the market goes back up, activates a signal again, you can always go back and add more. In fact, if you're looking to trade multiples, it depends upon your profile. Here, the target was completed at the mean, 27.94, and we reverted back down again. Here's where you go neutral, or you reduce your multiples. You wait patiently for the price to come down and resolve the energy into this level that now is suggesting to accumulate supply. and you begin to see the reversion unfolding. Finally, the market went through the average daily and weekly, and the energy resolved right away the way it's supposed to and met the target, 2834. Here is where the signal was activated, and here's the highest probability to take a signal and go short from this level, or begin to continue to sell the strategy against the sell one level. And the market could not find the strength in buying against the supply that was being offered here, and obviously you saw it react and come down into the target of the mean. You went flat again, neutral, and now we are waiting for the extreme above or below the mean to be activated. And as you can see here, the momentum identified the bearish price momentum and almost came down again to that buy one level of 27.52, which is the extreme now below the mean of 28.34. And we are waiting now patiently for a signal either to come down to test the 27.52 or to go above 27.94, which is the harmonic relationship daily and weekly, and activate another bullish price momentum, activating the targets above of 28.34, 28.56, all the way up to 28.62. If we take a look at the silver market, pretty much in the same situation here that we saw on the 26th, the market come into this daily average price and the weekly short trigger, which is where we are right now, activating a bearish price momentum and a weekly short trigger. This trigger gave you the opportunity to lock in a profit all the way down to the first time was 1892 with a trailing stop. This is the only level that I suggest for you guys to use a trailing stop when the market moves in your direction. It would have stopped you out, came back up again, it activated again the weekly short trigger on the 27th by going up to 1902 at 5:45 a.m. today, and it took out the 1902 target and came down to activate a short trigger at 6 a.m. And that short trigger is in place with the target below, which almost was completed at 1890 by making a low of 1890.80. So this is how accurate this tool can be in following, the AI pretty much that it recommends. So we are in a neutral zone on the daily signals. We are in a bearish trigger from the weekly signal, and the target is the 1871, which is the weekly average. But in between, you can see the daily is in an area of buy, the buy mode, or the accumulation area of 1890 to 1880. So we want to see the market trade, if it's going to trade in this area, and pretty much have a pretty good idea of what what the supply and demand resolution is going to be there. Coin continues to make new high here, so continue to hold your coin. And if you're long the GBTC, that is up as well. Continue to hold that. The derivatives are a little bit bearish here this morning, with Nugget down about 96, JNUG down about 111. Slightly lower in SILJ. GDX is slightly lower. So it's a kind of a neutral to slightly bearish market, but I think as we move into the end of the month, we can expect a little bit of selling pressure, particularly for the expiration of the options contract. We have a holiday on Monday, by the way, and it's going to be interesting to see what happens here after the holiday. So I would be just a very cautious going over the holiday, and maintain your long strategy, your bias, maintain your core position intact, and look for opportunities that we can get into the next early part of June to build and accumulate again to your core position. I think the market is definitely building a very solid base that is attracting new buyers at higher levels, and I think it's just a matter of time before we really see the market revert back to its real mean. If you take a look at the 360-day cycle, as we talk about the 360-day cycle here that we published in Seeking Alpha back in September, you're looking at the target. Once the market came above the 1810 level, it activated the bullish price momentum, as you can see here, and automatically the target above the seller one of 2164 is in place. This is the annual 360-day cycle. This is the target, the annual target. And what the cycles indicate for us that we use, that this target potentially could be completed sometime in August. Now, that is the time frame, the window, the time and price window of our cycles that we use. If we take a look at the market right now, it's breaking out of this Fibonacci trend line, fan lines resistance, and incorporating the Fibonacci retracements. We're pretty much breaking out of a 50% correction. This is the 50% level from the high that we made last year to the low that we made recently here. And we're looking at the market reverting back up to even the 2023, which is a 78.6% retracement. And you can see here the previous target of 21,1270. And if we again get through these levels, the target in place is 2164 to complete this pattern that we seem to be building and breaking out. So don't despair in terms of if we see a little bit of correction, use it to generate some liquidity basically, and add to your long-term position here. Continue to hold your position intact. So any surprises are going to be to the upside. I will continue to update you throughout the day, as you know, and any questions at all that you have, you know where to reach me. In the meantime, have a great trading day, guys, and I'll talk to you soon.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit EMA2trade.com for more details.